Welcome to the deep dive video update. And I always want to explain my context of deep dive. Every day I do lots of videos and I do many videos each week. I look through hundreds of charts. At the end of the week, I look through all the charts, mainly the daily charts that I consult. And I go through and I say, okay, sometimes I use that chart, sometimes I don't in the videos that I do every day. Well, the ones that I don't use very often, or maybe I use for a period of time and then don't, I put them into this video. And that's why I use the name Deep Dive. Not really blatantly speaking to us now, but sometimes we can get some additional insight by looking at these charts. There are also other charts that are unique just to this particular video that are more informational. And this is being prepared for Monday, February 3rd. The first chart is informational. Now, I do a lot of different studies on the VIX. The VIX is a fear gauge. When it's going up, that means fear is increasing. When it's going down, that means fear is decreasing. Well, to give us a little bit bigger picture of what's happening with the VIX, I plot the VIX on a chart and then I turn it invisible. And over top of that is a 50 period exponential moving average. And you can see we can get a pretty decent idea of what is the range of the VIX. When we're in a bull market and things are more positive, the VIX drops to a lower range. When the market's under pressure and going down, or we're actually looking at a bear market, the VIX goes up to a higher range. Well, we're still in that lower range right now. And I like to look at this even though it's very long term. This chart goes back to 2005, so 20 years are on this chart. So this just gives us a bigger picture look at things. Also, this has been in the video quite a bit each day when we were going down and really under some pressure. This is a variation of the VIX. It was designed a long time ago, mainly to deal with mutual funds. Now, mutual funds only have a closing value. That's called the net asset value, where you don't have an open, high, low close. Well, this was designed saying, okay, we're only going to base this around closing prices. And it's called the ulcer index because when it's going up, your ulcer is probably getting more intense. And when it's going down, things are calmer. I usually only show this indicator when we're above the moving average. I plot a long-term 200-day moving average here to give us a general sense of the range. Well, we've dropped underneath the moving average. And so since we're below that, I stopped showing this in the daily video. If we start to go back down and fear really picks up, this chart will probably go back into the daily videos. Another study that I do with the VIX is a VIX to S&P 500 correlation. Sometimes we can get some insight from this chart that maybe we're not picking up in other studies that we do of the VIX or even in the VIX itself. Usually when the VIX gets above 20, that's when we really start to get nervous. To give it a little more context, there's a 5-period moving average here of the VIX. But the area that I really concentrate on for this chart is in the middle, the correlation. When we get above this dashed line, that means that fear is coming into the market. That means the VIX is going up, but the S&P is probably going up too. And sometimes that can signal a really high reading. Or the VIX is outperforming the S&P 500. It's going up faster than what the VIX is. Right now, we're getting a pretty low reading. And so when we're down around the area that we're at now, it's not really telling us anything that we're not seeing in other charts. Now we look at the VIX, and then there's like an indicator on top of the VIX called the VIX of the VIX or VVIX. And then I just look at a ratio between the two. We've been chopping around now for the last year, year and a half or so. What I really watch for is when we really get screaming, this goes up. That usually means the market's going down. That means the VIX is going up faster than the indicator. The volatility of the VIX is indicating. And then when we're really coming down with this, that's typically when we're going up. Well, we've just been kind of meandering up and down, up and down, up and down over the last year, year and a half. So we're not really getting a lot of additional insight from this chart. This chart comes in and out of the daily videos when we're really moving either to the upside or to the downside. And this just measures the speed of the VIX. It uses an RSI based on 9 periods, and we're just about at the middle right now. Also, we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the move index, and do a ratio between the two. Typically, I follow the red moving average here that's based on 50 periods. Not really getting an awful lot of insight right now. This comes in and out of the daily videos too. It's a risk on to risk off ratio. Not really, I mean, we came down a little bit, but we've just been really choppy over the last few months. And we dropped a bit in Monday's session when we had that big scare because of DeepSeek, the AI model from China. Well, it hasn't really been changing all that much since then. And we look at a ratio between large caps and small caps, also chopping around right now. If we really show some conviction, either going up or down, then I'll break out this chart and start to show it. Then this is informational, so I don't show this in the daily videos, just to give us an idea of where are we at from where have we been. If you go back to the low that was set in October 2022, and that's when we finally bottomed, and as of Friday's close, we are up 72.58%. If you go to the low that was set in October 2023, up to Friday's close, we're still up 47.19%. All right, then stockcharts.com puts out these things called technical alerts. They're not just for the S&P, they're at other indexes, they're at sectors. They even show Canada in here. And when we see an awful lot of red, that's negative. When we see an awful lot of blue or green, depending on what color you see, because I've had people tell me, no, I see blue. And other people say, no, I see green. So take your pick. We'll just go with the rainbow theme here. And when we do see that blue or green, that means more positive things are happening. Now, I break these out. You look over on the right-hand side, they're all broken out from date. The bottom is Monday, the top is Friday. And I go through them in the daily videos. But then this, I just show what were all of the alerts for the past week. And you can see down days usually have red, up days usually have green or blue here. And so I don't go through the individual alerts. This just kind of gives us a sense on a color perspective of are we looking positive or negative. Then, and I added one more. Stockcharts.com has this other tool that tries to even further eliminate emotion from a price chart because that's what technical analysis is supposed to do. You're not just watching a stock and wanting to get in and going in on a hunch and having a good feeling because you'll be right just enough to justify you doing it that way, but you'll lose a lot more than you'll win. Well, technical analysis is supposed to say, okay, all the information that is known, I'm seeing right now in the chart. Well, because there are so many other indicators out there, you can line up 10 people and they could all look at the same chart and come to 10 different conclusions, whether we're going to go up, down, or sideways. Well, stockcharts.com tries to take different technical analysis indicators and then say, okay, what charts are looking the best right now from a technical analysis perspective? No emotion, just unemotional criteria. And it scores them on a scale of 0 to 100. The higher the score, the better looking the chart. Then what I did is I used to show 5 indexes. I have the S&P, that's my main focus, the Dow, the Nasdaq 100, the mid caps, and the small caps. Well, because for the last 6 or 8 months, since the summer of 2024, the Nasdaq composite, which is a much broader index, it's been outperforming the Nasdaq 100. And I usually follow the Nasdaq 100. Well, there's a popular, kind of popular ETF out there that tracks the NASDAQ composite, not just the NASDAQ 100. And so now I'm looking at 6 indexes now, and then I rank them here, starting with what is looking the best. Okay, we have the QQQs, which is the NASDAQ 100. That's coming in the best right now, even though tech has had a little kind of a lazy, laggard, sloppy start to 2025. This is where the big tech names reside, the mega cap 7 and the stocks that everybody likes to talk about. Well, these stocks are also in the S&P 500, but when you look at them by themselves and looking at technical analysis, this is coming in first place this week at 83.7. Now, when we're really strong and the market's really moving, this score will get up into the 90s. So yeah, we're looking pretty good here, but at the same time, it's not looking all that great at the current time. Then in second place is the Dow. Now, sometimes the Dow comes in last place. These are the 30 biggest, supposed to be the best of the best stocks in the US. They're called blue chips because if you play poker, the blue chips have the most value, and they tend to be the stocks that stand the best of time. Well, as of 25 years ago or so, they started to include NASDAQ stocks in the Dow, and Nvidia was just recently added to the Dow. Those are all growth stocks. But when you take the name Dow Jones Industrial Average, first of all, there's nothing industrial about it. They're supposed to be the best of the best stocks. And it's the editors of the Wall Street Journal that determine what stocks go in there. And there's 30 stocks. Now, I don't use that as my main benchmark, but a lot of people do. And if somebody says, oh, the market's up 1,000 points, down 1,000 points, they're probably talking about the Dow, which to me is also irrelevant. That's why I focus on percentage moves. Because when you're at 40,000 with the Dow, a 1,000 point move is a lot different than when we were down at 5,000 for the Dow. Okay, so it's irrelevant. I look at the percentage move, but coming in here at 83.6, earnings are coming out, and when earnings are good and the market reacts positively to those, that has more of an impact on the Dow. Then here's the new addition. This is the Nasdaq Composite, and there's an ETF out there called 1Q, and it's coming in third place at 83.5. Then we have the S&P 500. A little bit under pressure, not really trending right now on either our daily charts or our weekly charts. Not looking really weak, but not looking really strong at the present time, coming in at 78.5. Then we have the mid caps coming in at 63.5. And then in last place this week are the small caps, as represented by the IWM Russell 2000 small cap ETF. Yeah, small caps should have been at the moon by now, or at least on their way, but they're just not doing very good. And if you watch the videos that I do every day, I also have a newsletter that's currently free that you're welcome to subscribe to. And I post it in a private Facebook group, and just send me an email and I'd be glad to send it to you as I'm working through the process of, okay, how do I want this newsletter to go? I'm just kind of putting it out there at the present time. But okay, why was I talking about that? Anyway, we're having a really difficult time getting above the 50-day moving average. Now, I look at two small cap indexes in the daily videos, the S&P 600 and then the Russell 2000 small cap index. Both of them are not able to get above their 50-day moving average, and that's why they're coming in last place. They're coming in at 49.1. If the small caps were really strong right now, they'd be at 85, 90, 95. All right, so then I have another short-term rainbow. Rarely do I use this in the daily videos. Right after this, I do another video called the What to Watch video, and sometimes I use these charts there. This tries to take a bigger picture look at the short-term time frame and what is the trend that's actually happening. And I have 10 to 50 period simple moving averages plotted here. They're in different colors, and it kind of makes it look a little cool. And we're positive. Even with the rough, choppy week that we had this past week, we ended up being down 1% for the S&P from the previous Friday, but we're still above the rainbow here. So the short-term trend is still positive. Now, I measure the short-term trend by the 20 period moving average, but I also have a 10, 30, 40, 50 here. But we look at the overall direction of the lines that make up this rainbow. Are they starting to jumble all up? Are they rolling over and going down? We were jumbling up there for a while, but now we're back above the rainbow. Then, this is an indicator that I developed decades ago to do a particular strategy. I don't do the strategy that much anymore, but I kept this chart, which is really very simple. It's a 20 period simple moving average of the open, high, low, close. That creates its own little mini rainbow. And it's kind of interesting how this has worked over the years. When we were going down in December and we were trying to bounce back up, you notice how parts of this rainbow acted as overhead resistance. Well, then when we were coming up, we broke through the rainbow, and then we've been coming back down a little bit. Part of this rainbow was acting as support. and we're above the rainbow now. As long as we're above the rainbow, I don't use this in the daily video, but we're positive because we're back above the rainbow and the lines are starting to go back up. All right. This comes in and out of the daily video as well. There's an advanced decline ratio. This one's based on the short-term time frame, 19 days. There's also a 35-day advanced decline ratio where I show it based on price in the other chart, where here it also breaks it out on volume. And so when we're above zero, we're positive. When we're below zero, we're negative. We can also use this like an oscillator when we get an extreme positive or negative reading, both either on price or volume. And this is the boom indicator. This measures how far away are we from the either 20, 50, or 200 period moving averages. This also works like an oscillator. And for a few days there, when we were going up, we were getting kind of far away from the 20 period moving average because price tends to not get all that far away. It's like a dog on a leash. You'll let it go so far before you reel it back in. That's what happens here with this indicator. And I used this for decades. I just never gave it a name. And then I was attending a webinar a few years ago, and a guy was basically explaining this concept that I'd been using for a long time. And he would say, okay, you get too far away from the moving average, boom, you go back. You get too far underneath it, boom, you go back. That's where the name comes from. It was just a silly little webinar that I attended. All right, then intermediate term, we're looking at another rainbow here going from 50 periods up to 100 periods. We went into the rainbow when we were falling back, but then we came back above the rainbow and we weren't in there very long. So the line still continued to be flat and still continued to go up. That just means the intermediate term trend is still comfortably intact for the time being. Bollinger Bands, and as I say usually every week in this video or whenever I talk about Bollinger Bands, there's a book written by John Bollinger himself that talks about how you can use Bollinger Bands. This is just one implementation of that, where I use a thing called the percent B indicator, and that measures, okay, are we above or below the midpoint? Well, we're above it, so we get a positive answer. Well, then the percent B measures, do we close outside of the upper or lower band? That doesn't happen very often, and when it does, it tends to not last very long. We're in between right now. So if we do really start moving in one direction or the other, chances are this chart will pop up in the daily video. In the meantime, it's in the deep dive video. All right, then we measure the distance from the 200 period simple moving average. Not really an issue, more for informational purposes, unless we start getting kind of far away from that. You notice last summer, we were really going up really nicely, but we were getting about 15% away from the 200 period moving average. And that's when we rolled over and had a bit of a correction. This was the end of the world day here in the beginning of August. Well, then after that day came and passed, and we're still here, we bounced up out of that. But we can use this to say, okay, we're like the boom indicator. We're getting kind of far away from that 200 period moving average. And then there was just about, a little bit less, but just about from this top to this bottom, about a 10% decline. That's another important number that we keep an eye on. Well, we got just about to that 10% level. Everyone else is screaming end of the world, sell, sell, sell. The smart money is coming in doing buy, 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 and then we bounce up from that. All right. Then just some rough measurements, and I have to eyeball this, so don't quote these percentages. That's what I was just talking about. When we topped out in July and then we retraced almost 10% before we bounced up. Well, we also measure from the October 2023 low to Friday's high and giving an idea of how much we're up since that point. When we hit our all-time high in December and then we started going down, we were down a little bit over 5.5% at that point. So there are machines, algorithms out there for computers that do all the trading and people that watch this. They say, okay, we hit an all-time high here. We're going down. We're going down. If we get close to that 10% point of a retracement, because we're not looking at taking the market and having it turn more negative, we're going to use that as a buying opportunity. And when we get down to around this point, now start buy, buy, buy like crazy. And you get a lot of the smart money, which is the massive money, coming in and doing the same thing at the same time. That's how we bounce up out of these things. All right, then we have another oscillator here, the Connors RSI. It's pretty spastic on a day-by-day basis. I only use this when we get above the black line or below this black line. That just means we're moving kind of fast. We're not now. Anchored moving averages, kind of a interesting, unique way of using moving averages, where typically moving averages will take the last number of periods, like 10 periods, add them all up and divide by 10. And then that's the current value for right now. Well, this anchored moving average, it tries to project things going forward. And when we were coming down here in December and in earlier in January, we fell below this short-term anchored moving average, but we were able to get above that. We're not too far off of the all-time high here. One thing that we're kind of watching for, this is just a little side note that I remembered, we're wondering is some kind of a double top being created in the S&P. We came up here, came down, tried to come back up, and now possibly going back down. There's probably some folks out there who are screaming that, but we're for right now, we'll just note that, not necessarily declare it as truth. We'll just say, okay, that's an observation. And then if we see other things starting to deteriorate with our charts, then we'll put a little bit more legitimacy in that observation. But we haven't even come back down to the southern anchored moving average yet. Another takeaway from this is all the other anchored moving average. I have one going back to the COVID low. There's another one from the all-time high that was set in early 2022. And then it just goes out infinitely forward from there. And you notice all these lines are going up. And that's also that the market is more positive. All right. Now, if we start to see more of a decline, this chart will be one of the first ones to go back in the video. This is a 50 period moving average, both a simple, that's where all 50 periods are the same, and then exponential moving average, where they weight it more towards current price. And I get asked this all the time, what's better, a simple or exponential moving average? And my answer is both. I use them both. So that's why you see two lines plotted on here. And this is the intermediate term trend. As long as we're above this, we are positive. Now we had a really solid day on Friday, and then we gave all that up and closed pretty much at the low, just a little bit off of it. Now, if we see some more weakness in the upcoming week, then these lines are going to come back into play. Then looking at the CMB composite, it's another oscillator that I only show when we got above this black line. When we drop down below it, I stop showing that. Then I'm also looking at the 100 period moving averages, both the simple and exponential version. When we were going down here earlier in January, this for 3 days provided good support on a closing basis. We came down to the 100 period moving average, but we still closed at it. The next day we closed above it. The next day we closed above it. That's good, solid support right there. And then boom, we bounced up out of that. Well, since we're kind of above these lines for right now, we're still dealing with the 20 and the 50 before we even get to these lines. And so if we do start to see more weakness, then this chart will go back into the video as well. And we just want to keep an eye on the S&P 100 and compared to the S&P 500. Not really seeing anything all that out of the ordinary right now. Standard deviation, this doesn't measure direction, it just measures speed. When we were really going up, the speed was really picking up. And then when we bounced down, the speed was dropping off. It just goes back over the last 10 periods. And when we drop back down below this moving average, that's when I stop showing it in the videos. Point and figure. Showing this a lot in the previous week. Not didn't have to show it at all this last week. This is point and figure. It doesn't take time into account. It just takes price movement. So whatever it takes for a new X to be drawn in here, that could take an hour or it could take a year. Then a new X is drawn in, regardless of the date when that happens. And when we're going down and we go down by a certain amount, no matter how long it takes, then an O is drawn in here. It looks like an old football diagram if you ever played football. X's and O's. Tic-tac-toe too. But we were getting a little bit concerned here because we came up to this same level and went back down. Came up to this level, back down, up, level, down. We finally broke above that. And so this is more positive, but we haven't seen enough price movement yet to draw in any new X's or O's over the past week. Long term, another rainbow. Yes, I'm just like Dorothy, somewhere over the rainbow here, going from 50 periods up to 250 periods. Even with the pullback that we saw in December and into January, we weren't in there long enough to even turn these lines. They're continuing to go up and we're back above the rainbow. This is showing that the long-term trend is still positive. This is a long-term oscillator that I look at every day and is quite important, but it's so long-term. Why show the chart unless we're actually crossing either above or below this red line? We're not. We crossed over in 2023 and we've been above it ever since then. This is the special K, just like the cereal. Then we look at the relationship between what's happening in the US and what's happening in Europe. And we look at a weekly chart of the S&P on top and a weekly chart of the German DAX. That's the biggest stock market in the EU. And so we want to keep an eye on that. And you notice how the German DAX is hitting all-time highs here? They've just been doing really well lately, where the S&P has been lagging a little bit. And so we're seeing the correlation between the two dropping off right now. But we'll just have to see if it gets back more into line. Then different support and resistance levels. No need to show this until we really start to drop. This is Fibonacci retracements. And every time we set a high, I come in and readjust this. And if we come all the way down here to the 61.8% level, then I'll start showing this chart again. And the idea is that we measure from the low to the high and look at possible retracement levels based on Fibonacci numbers. And then this was in the video for quite a while, but then we got up out of the cloud. I mainly use this as a support level. If we're above the cloud, that's positive. If we drop below it, that's negative. When we're in the cloud, we're looking to see if that will provide support. Well, there's also additional studies, and we're positive on this chart right now because the blue line crossed back above the red line. There's also a green line buried in here somewhere that's been kind of choppy lately. That's really short term. This is more intermediate term when we see the blue and the red line here. So since we're above the cloud, I stopped showing this chart. Some broad market measures where I talk about the VIX as it applies to the S&P 500. There's the Vixen, gotta love that name, that applies to the NASDAQ 100, just giving us a measure of volatility there. And then we look at the S&P on top, and then we take the growth, QQQs, versus value, diamonds, Dow, which also includes Microsoft and NVIDIA. And we just do a ratio between the two, and it's kind of neutral right now. We're not seeing a really strong reading, meaning they're going in the same direction at the same time. And we're not seeing an opposite reading, which means one's going up as the other one's going down. So we're not really getting a lot of insight here. We want to keep an eye on the transports, which are really lagging the Dow. We've got Dow fairly close to an all-time high here, but the transports, which is in red, they just kind of have been chopping sideways and underperforming. We want to keep an eye on the banks, especially the smaller banks, the regional banks. And then we do a ratio to the financial sector. Now, the financial sector is doing okay, and we like that, and that's positive. And we want the financial sector to do well. And I've been watching another ETF called the Bank ETF. They were able to get back above their 50-day moving average, and so far they've been able to stay above it. Well, we want to keep an eye on these smaller banks. When this really took a dive here, that's when Silicon Valley Bank went under. And then later on, there was Republic Bank. And then at the beginning of 2024, there was New York Community Bank. With interest rates going up and them having to refinance at higher rates, and this could be really biting into their earnings. And they went out and bought a lot of treasuries that are giving them very low returns, and just a lot of things that could go wrong with those banks. We just want to keep an eye on them, but we're not really seeing much of a change here with this overall ratio. And then staples to tech. Sometimes I show this every day, but it's been declining. Monday, when we had the scare day with DeepSeek, it really shot up. That means staples shot up compared to tech. But overall, we're still declining here when we look at the staples to tech ratio. When this is going down, that just means tech is outperforming staples, and that's usually positive for the market. And I have a couple of rate of change charts that are long term and just for informational purposes, going back 250 periods, holding up fairly well here. Also 250 periods, but going back further. We drop below this blue line, but we're still holding up okay with the longer term rate of change. Keeping an eye on bonds, we're looking at the ratio between cash and 3 to 7 year bonds based on price. When this is going up, that gives us a little bit of a concern. That means interest rates are going up, possibly inflation's going up. This is going up with a trend here, but we've been pulling back lately. And we're coming back down to the 50-day moving average with this ratio. If this could continue to fall and actually turn over eventually and roll negative, that would be more positive. That means the market isn't as concerned about inflation, and that also means that interest rates are coming down because the 3 to 7 year bond ETF is going up based on price. We also look at TIPS, which are Treasury inflation protected securities. That's what folks get into when they're worried about inflation going up and interest rates going up. And you can see over here, they were really outperforming. Then inflation started to get under control in about June of 2022. We saw this ratio coming down. And then we've been kind of going up a little bit, down a little bit. We've been coming back up, but we're still in a downtrend here. The economic reports that have been coming out have been solid. And the Fed already came out in December and said, we're not going to lower rates anymore for a while. And they just met this past week and lived up to that. And they're a little bit concerned about inflation. So that's why we're seeing this ratio going back up slightly. It would be more positive if this was to turn over and go down. That might give some more support to stocks. Let me look a little further out. Tips to 7 to 10 year bonds. The previous one was 3 to 7 year bonds. This is continuing to go up as we're seeing the 10 year and the 30 year bonds, the longer end of the yield curve going up, and that's causing some problems. And we're above 4.5% with the 10 year yield. And that's why the market's, and one of the reasons why the market's been under pressure lately is interest rates are going up. They're still going up, and we're still in an uptrend here. For this to turn more positive, we want this ratio to come down. Then we look at the long-term bond ETF, usually centered around the 30-year bond. That's in blue. And we look at the S&P 500, which is in red. And we look at the long-term correlation, getting a little bit weaker here, really dropping off with the short-term correlation now. That's based on 10 periods. We do that same thing with the Qs, the NASDAQ 100 to the long-term bond ETF, which here is in red, where on the previous chart it was blue. Just wanted to go with the Christmas theme throughout the charts here. Neutral right now with the correlation. Really no edge to either side right now. Then we look at, and this is crazy, and I didn't come up with this study myself. I forget who did, but it's just somebody actually sat around and thought this up. You take the 10 year yield in the US and you subtract the German 10 year yield, and then you plot the difference between the two, and you put the US dollar index here, and then you do a correlation between the top chart and the middle chart, and there's a pretty strong correlated relationship here. And this is just showing the interplay between currencies, not only in the US, but Europe, because that's mainly the euro. I guess, do they still have the Deutschmark there? And then the dollar index here. I guess this is the 10 year Bund. And then it just shows interest rates and currencies interacting with each other. And usually we get a fairly high reading up in this blue area. It's showing that this is normal. This is usually how it works out. All right, then we keep an eye on the 2 year Treasury yield. That's more short term. Not really giving us a lot of insight right now, so I haven't been showing this chart lately. And then just to make it even a little weirder, we look at Eurozone stocks and how are they doing compared to 3 to 7 year bonds in the US? Well, Euro stocks are really outperforming now because bond prices have been going down in the US, and the German DAX and the whole EU is looking pretty solid right now. So we're seeing a really strong relationship here. Then these things called possible positive scenarios, I really used them heavily back in 2022 when we were in a cyclical bear market. Well, I still use some of those charts in the daily videos, and the charts I show here, ones that I rarely show now. This is the percent of stocks in the S&P above their 200-day simple moving average. Now, I have a different chart doing the same thing. I just look at it in a little different way. This one is designed to be an oscillator. When we get above the green line or below the red line, we're not there. The takeaway here is that we're above 50, so we are positive. If we drop below 50, then we're turning more negative longer term. That same basic approach here with those stocks in the S&P above their 50-period moving average, not extreme positive or negative, but above 50. Then we look at the mid caps, not extreme positive or negative, but still above 50. Small caps, not extreme positive or negative, below 50. because they've been really struggling lately to really go anywhere. And then this usually gets put in every daily video, but we've been just declining and then kind of chopping around lately. This is a ratio between staples to the S&P. When this is going down, that means the S&P is outperforming staples. Staples are defensive. When staples start to do well, like they were doing and outperforming in 2022, that's when the market's going down. So we look at this ratio, and as long as this keeps declining overall, that's more positive for the S&P. Thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.